Chapter 6: Evaluation of Ecosystem and Client Sensitivity in Managing Situations. Introduction. In the realm of financial advisory and planning, professionals encounter a myriad of challenges, particularly in grasping client sensitivities and biases. Understanding and addressing these biases are pivotal in steering clients towards prudent investment behavior and sound decision-making in portfolio construction. Central to client engagement and retention is the meticulous administration of portfolios vis-à-vis appropriate benchmarks and the critical evaluation of their performance. Managing portfolios encompasses a multifaceted approach, commencing with the analysis of the economic landscape, followed by sector and industry-level risk and return evaluations, and culminating in granular, company-level scrutiny and stock selection. While various valuation methods are advocated, none can singularly provide sustained evaluation of stocks and portfolios. Instead, a judicious amalgamation of styles is advocated to navigate managed risks and achieve commensurate returns. Client sensitivities. Understanding clients. Risk-averse and risk-seeking. Risk profiling is foundational in money management. It involves assessing a client's willingness, risk appetite, ability, risk capacity, and tolerance, risk tolerance to take on risk. Misalignment often occurs between these elements. For instance, a client may have high risk capacity but low risk appetite and tolerance. Willingness to take risk is primarily influenced by personality and reaction to asset value fluctuations, indicating the level of risk aversion. Risk capacity is objectively measurable through parameters like net worth, cash flows, and asset-to-liability ratio, helping to remove emotion from discussions and focus on facts. Risk-averse versus risk-seeker. Clients exhibiting low willingness to take risk are termed risk-averse, while those willing to endure swings for higher returns are risk-seekers. A risk-averse investor is someone who prefers lower-risk investments and prioritizes capital preservation over potential high returns, often exhibiting a cautious approach towards market volatility. Conversely, a risk-seeking investor is inclined towards higher-risk investments, motivated by the potential for greater returns and willing to tolerate significant market fluctuations in pursuit of their financial goals. Motivation for risk-seeking is driven by specific goals like quick gains or short-term financial objectives. Factors influencing risk capacity include retirement funds, family setup, and financial support, which modify risk tolerance over time and may lead to a notion of risk neutrality. Risk-neutral investor exhibits moderate risk tolerance and sufficient capacity to absorb short to medium-term volatility. Impact of framing risk tolerance questionnaires. Risk tolerance questionnaires are designed to assess individuals' financial behavior, considering their tendency to react based on the risk and uncertainty present in events. Typically, individuals exhibit risk aversion towards gains, preferring certainty over a gamble for an equal or higher expected value, while they tend to be risk-seeking about losses, favoring a gamble over a sure outcome for an equal or lower expected value. Therefore, it's crucial to carefully frame questions in these questionnaires to accurately capture individuals' risk tolerance. This phenomenon aligns with prospect theory, formulated by Daniel Kahneman and Amos Tversky in 1979, which suggests that describing the objective risk inherent in a situation influences individuals' behavior towards that situation. Individuals tend to dislike losses more than equivalent gains, leading them to overvalue certain options with lesser assured gains over others, offering potentially higher returns but with a slight chance of getting nothing. However, this bias reverses when faced with the prospect of a loss, prompting individuals to engage in risk-seeking behavior to avoid larger losses, resulting in different responses even when the outcomes are the same. This bias in decision-making, known as framing, must be considered by intermediaries, advisors, and financial planners when analyzing their clients' financial risk. Care should be taken to avoid framing biases in risk tolerance questions to ensure an objective assessment of a client's risk profile. Dilution in risk management due to overconfidence, advisor or client. Overconfidence, whether justified or not, in one's abilities can lead to the neglect of certain risk management measures. In the realm of financial management, where numerous factors contribute to or influence outcomes, it's essential to recognize the inherent uncertainties. While it's impossible to predict all these factors' precise effects, professionals strive to understand each factor and craft responses that maximize desired outcomes while minimizing potential downsides. However, failure to acknowledge this uncertainty can lead investors, fund managers, and advisors to succumb to overconfidence or over-optimism biases at various points in their learning curve. Overconfidence, stemming from education, certifications, or past successes, may cause professionals to overestimate their recommendations' potential benefits while underestimating associated risks. Similarly, individuals with less knowledge and experience may exhibit overconfidence due to ignorance of their limitations. Both overconfidence and over-optimism biases can lead to irrational exuberance, as witnessed during the 2008 global financial crisis, when market players ignored underlying asset values in favor of blindly following market trends. These biases are challenging to detect and correct swiftly due to the rapid decision-making process. One potential solution, suggested by Baker, Philbeck, and Ricciardi, is to slow down decision-making processes to allow for thorough consideration, especially in extreme scenarios. Taking extra time to deliberate or seeking independent opinions can strengthen risk management practices and mitigate the impact of overconfidence and over-optimism biases. Goal setting and emotions. Retail therapy, emotional spending to escape stress. Retail therapy also known as emotional spending, often occurs when individuals lack control over their discretionary expenses, succumbing to the temptation to make unplanned purchases, particularly during times of stress. This impulsive behavior can strain budgets and result in unnecessary guilt over accumulating items. To address this, experts recommend strategies such as implementing a 48-hour waiting period before making purchases, making unplanned purchases more difficult, and removing triggers such as mobile apps that encourage impulsive spending. Additionally, establishing a well-defined budget, prioritizing non-discretionary expenses, and planned investments can help curb emotional spending, ensuring that discretionary expenses are kept in check. Understanding and addressing home country bias in investing. Biases, often ingrained from past experiences and influenced by familial and societal factors, significantly shape our financial decisions, including investment choices. Home country bias, whether rooted in optimism, pessimism, or indifference towards global markets, permeates various investment decisions spanning real estate, stocks, bonds, and mutual funds. Despite the availability of opportunities for international investment, such as through the Liberalized Remittance Scheme (LRS) in India, home country bias persists, hindering diversification and potentially limiting returns. For instance, the allure of investing in prominent US technology companies like Facebook, Amazon, Apple, Netflix, and Google has captivated many investors, contributing to substantial market capitalization growth compared to other companies. Financial planners advocate for optimized portfolios that encompass diverse asset classes and geographical regions to mitigate risk and align with financial goals. Investing abroad not only offers diversification, but also the potential for enhanced growth. However, it's crucial to seek expert advice from advisors and fund managers, considering various factors such as currency risk, geopolitical instability, and tax implications. Mutual fund schemes and ETFs provide avenues for international exposure, allowing investors to diversify across geographies like the US, emerging markets, and the Asia-Pacific region. By adopting a diversified approach and leveraging professional guidance, investors can navigate the complexities of international investing and potentially unlock greater opportunities for portfolio growth while managing associated risks. Optimizing diversification and portfolio turnover. Diversification serves as a fundamental strategy to mitigate unsystematic risk in investment portfolios, with mutual fund schemes inherently diversifying investments across multiple securities and asset classes to balance performance and risk. While diversification reduces concentration risk, it also addresses various other risks such as credit, interest rate, market, and liquidity risks. For direct investors, limited resources and expertise may hinder comprehensive risk management, making mutual funds an advisable avenue for market exposure. However, high net worth individuals seeking elevated returns often favor concentrated portfolios through portfolio management schemes, PMS, or alternate investment funds, AIFs, where customized portfolios can be tailored to manage additional risks. The optimal level of diversification remains a pertinent question. Benjamin Graham's Intelligent Investor suggests that a diversified equity portfolio typically comprises between 15 and 30 stocks, meeting quality criteria like market capitalization, earnings stability and growth, dividend record, and reasonable valuation ratios. Qualities often mirrored in market indices. Key factors to consider in diversification include company size, sector, geography, and investment style. Exceeding 40 stocks in a self-created portfolio may hinder effective monitoring, while mutual fund schemes typically hold between 30 and 50 stocks. Over-diversification occurs when investors spread investments across multiple schemes with similar benchmarks, diluting potential returns. Riskier assets, such as small and mid-cap companies, may necessitate broader diversification to manage stock-specific risks and capture upside potential. This principle extends beyond equities to bond funds, where diversification across 3 to 4 funds with varying company profiles is recommended to mitigate credit and liquidity risks. Exposure to approximately 80 to 100 bonds across companies provides adequate protection against default risk and minimizes the impact of individual defaults on overall portfolio returns, especially in cases of high overlap among bond schemes. Portfolio turnover. Similar to the impulse-driven behavior observed in retail therapy, stress can lead investors or traders to engage in excessive and frequent transactions driven by emotions rather than sound financial strategy. Financial planners caution against high portfolio turnover as it depletes funds through fees and transaction charges and may result in inconsistent performance. Effective financial management should prioritize alignment with short and long-term goals and tax efficiency, rather than an excessive focus on frequent trading. A systematic approach to investing and disinvesting in line with financial goals provides greater control, particularly during periods of emotional stress. It's important to recognize that refraining from action can be a deliberate decision in itself, such as maintaining course towards established financial objectives. Tendency of chasing past performance. A common disclaimer mandated by regulatory bodies such as SEBI in India or SEC in the US emphasizes that past performance of mutual funds does not guarantee future results. Despite this warning, advertisements and promotional material often highlight recent performance achievements, enticing investors and intermediaries alike to rely on past returns when selecting funds. While performance trackers prominently display such data, it's essential to carefully evaluate beyond these figures. Past performance can offer insights into a manager's track record, but it's not the sole indicator of future success. Like driving a car, investment decisions should not rely solely on the rear view mirror. Investors should assess the fund manager's investment objective thematic approach, and consistency in portfolio construction. Evaluating individual stock holdings and comparing them to the benchmark index can provide further context. Additionally, investors should consider whether recent benchmark outperformance is driven by outlier stocks not present in the fund portfolio. Expecting consistent market-beating performance over short periods, like quarters, is unrealistic and may lead to disappointment. Quarterly outperformance can be random and volatile, impacting both top-performing and average managers alike. A well-constructed portfolio should align with its investment objectives and maintain discipline over time, delivering performance in line with its theme. Ultimately, investors should set realistic expectations aligned with their financial goals.